The grocery industry is notoriously cutthroat and has faced a multitude of challenges in recent years. American grocers have had to deal with everything from shaky supply chains and labor shortages to chaotic mergers and acquisitions and massive amounts of debt. The pandemic caused many large-scale retailers to see huge spikes in business, but small and independent grocery stores were hit even harder. Despite having been well known in the past, many supermarkets have closed shop in recent years as a result of the weakening economy and the ferocious competition in the food distribution industry. This trend is leading to the disappearance of businesses that were once vital to local economies and social fabric. What has already disappeared and what will disappear by 2023? We'll let you know in this video. One example: Fresh and Easy, a British chain that entered the US grocery market with hopes to compete with American retailers, is now on the brink of closure. The company's timing couldn't have been worse, as it entered the market during a time when the economy and real estate markets were already slowing down. This resulted in the company accumulating a debt of a staggering $1 billion, with losses of about $22 million per month, according to court documents. Unfortunately, the company has had to file for bankruptcy and has closed 12 locations across the country. Its parent company, Tesco, is now trying to sell 30 remaining stores in an attempt to salvage whatever it can. The once thriving grocery store is now clinging to life, a victim of poor timing and unfortunate circumstances. Another example is Save a Lot, a St. Louis-based discount grocery chain that has been struggling to stay afloat for a while. It has been trying to shift to a wholesale model over the past year due to the numerous store closings it has faced. As a result, it has sold off 300 of its locations to independent retailers, leaving many customers without nearby options. The pandemic only exacerbated Save a Lot's troubles, and the company is now facing the challenge of navigating the recession that is slowly setting in. Save a Lot's revitalization plan is intricate, and its success will determine its fate in the coming years. If the company fails to complete the plan, it risks facing another round of closures that could potentially cripple its operations. The current economic climate is not helping matters, and it remains to be seen whether Save a Lot can weather the storm. The chain's struggles highlight the challenges that discount grocery stores face as they try to compete with larger retailers that have the resources to weather economic downturns. Fairway Market, known for its gourmet food and pack stores, has been experiencing financial difficulties for years before declaring bankruptcy for the first time in 2013. Even though it reappeared and became one of the most recognizable stores in the Manhattan region, the company's recent financial issues and crushing $174 million debt have caused it to go out of business. Only about 9 locations across 3 states have survived the downturn, with Fairway Market planning to file for bankruptcy a second time in 2020 and selling some of its locations to Village Supermarket, owner of ShopRite. The reality is that just because Fairway says it wants to continue operating does not mean it can, as recent history is full of examples of retailers who exit Chapter 11 only to quickly re-enter bankruptcy, many of which ended up liquidating and going out of business. Shoppers, a grocery chain that once had locations in Providence, Rhode Island, is currently experiencing a decline. The chain has shut down many of its stores, leaving only 14 Shoppers stores in the Washington, D.C. and Baltimore regions. According to the Washington Business Journal, loyal customers of Shoppers may have a year to 18 months before the brand closes entirely. Shoppers' parent company, United Natural Foods, has made the decision to sell or shut down most of its stores as a way of permanently exiting the retail business. This move is aimed at cutting costs and focusing on the company's core business of natural and organic food distribution. However, this decision could potentially leave customers in the affected regions with fewer options and limited access to affordable groceries. Despite the current situation, it remains to be seen whether Shoppers will be able to rebound and regain its former glory, or if it will ultimately be forced to shut its doors for good. Piggly Wiggly, a historic grocery chain founded in 1916 and renowned for pioneering the self-service shopping concept, has encountered its share of obstacles in recent times. The chain faced labor shortages in 2011, leading to the closure of some of its locations. In the first half of 2022, 3 additional Piggly Wiggly stores closed their doors, including ones in Florence, South Carolina, and Nashville, Tennessee, both of which had served their communities for decades. The closure of these stores has left many customers searching for alternative options for their grocery needs. The grocery industry is constantly evolving, and as new competitors enter the market and consumer preferences shift, established chains like Piggly Wiggly must adapt to stay relevant. While the closures of these stores are undoubtedly a loss for their communities, it's a reminder of the need for businesses to remain agile and competitive to survive in today's market. The grocery store industry is currently experiencing a challenging time, with several big-name chains struggling to keep up with their competitors. One such example is Sprouts Farmers Market, often touted as Whole Foods' main rival. The company's stock has fallen by over 24% since the start of the year, losing approximately $1 billion in market capitalization since the previous year. To cope with its financial woes, the company has been forced to close down several underperforming locations, and more closures are expected in the upcoming quarters. In a constantly evolving digital food industry, the prospects for small and regional grocery stores are becoming increasingly difficult. The shift towards online grocery shopping has created a more competitive marketplace where only the most efficient and adaptable companies can survive. This has resulted in many once thriving grocery chains being forced to restructure their operations to keep up with the changing times. Sprouts Farmers Market is not alone in facing these challenges. Other big-name grocery store chains have also had to deal with similar issues, such as declining sales, store closures, and increasing competition. In this challenging environment, only those companies that are able to remain flexible and adapt to the changing marketplace will be able to survive in the long run. Sam's Club, a membership-based retail warehouse chain, has faced numerous challenges in recent years. The company had to close hundreds of stores due to the pandemic and nationwide demonstrations in 2020, leading to a significant decline in profits. However, this was not the first time that Sam's Club faced such a situation. In 2018, the company closed 63 stores without any prior warning, leaving many employees without jobs. The move came as a shock to both the employees and the general public. Sam's Club was not immune to the struggles that other retailers were facing in the changing marketplace. The company began experiencing declining revenue back in 2015, and this trend continued for several years. Despite being known for its last leader strategy, where it deliberately lost money to crush its competitors, the megastore still struggled to appeal to its members. The closure of so many stores was a significant blow to the company, as it had to compete with other large retailers like Costco and Walmart. In response, Sam's Club began shifting its focus to e-commerce, offering online ordering and curbside pickup services to attract more customers. However, even with these changes, the company's future remains uncertain. In the highly competitive retail industry, it is crucial for companies to stay ahead of the curve and adapt to changing consumer demands. Sam's Club's experience serves as a cautionary tale for other retailers, emphasizing the importance of staying agile and innovative in the face of adversity. ShopRite, the largest retailer-owned cooperative in the U.S., has been around for over 80 years, continuing the tradition of neighborhood mom and pop shops. However, the company has been forced to close some of its most famous locations in the New York region due to declining profits. The same is true for Lucky's Market, a national food chain, which had to file for bankruptcy, close 80% of its stores, and eliminate more than 3,100 jobs. The current economic climate has been tough on all businesses, but as more and more mom and pop shops go out of business, we are forced to rely more heavily on corporate behemoths. Buyers are left with fewer alternatives and are more vulnerable to sudden price hikes. Unfortunately, thousands of grocery stores may shut down over the next few years, and these are just the opening chapters of a crisis that will play out over the course of several years. Inflation in the grocery store sector is here to stay. As consumers, we rely heavily on grocery stores to supply us with the food and products we need. Unfortunately, the current economic climate has been tough on businesses, particularly mom and pop shops. Lucky's Market, a regional national foods chain, is currently bidding farewell due to a significant drop in sales and financial difficulties. Despite offering wide selections of affordable food staples, the company had to file for bankruptcy and close 80% of its stores, leaving only 6 locations open. Similarly, Stop & Shop announced the permanent closure of several underperforming stores, despite opposition from customers. As more grocery stores face financial difficulties, buyers are left with fewer alternatives and may become more vulnerable to sudden price hikes. This crisis is just beginning, and inflation in the grocery store sector is likely here to stay.